Welcome to the Money Masters, the ultimate destination for anyone who wants to learn more about the world of investing and finance. Do you want to make some money from your investments, even when the stock market is going up and down? That's what dividend funds are for. They give you a little bit of money back just for holding onto the stock, even when the stock price changes. Today, we're exploring the realm of dividend holdings, a popular investment strategy for those looking to grow their wealth in a smart and steady way. With so many options out there, it can be hard to know where to start. That's why we're taking a closer look at two of the most popular ETFs in this space, SCHD and JEPI. By comparing their factual data and performance, we aim to help you determine which one might be the best fit for your portfolio. Whether you're an experienced investor or just starting out, you'll leave this video with a better understanding of what dividend holdings are and how to make informed decisions about your investments. So sit back, relax, and let's learn about SCHD versus JEPI as dividend holdings. First, let's take a look at the SCHD ETF, also known as the Schwab US Dividend Equity ETF. This ETF invests in high-quality, dividend-paying companies in the U.S. It has a history of consistent dividend payments and a low expense ratio of 0.06%. The portfolio of SCHD consists of companies with a proven track record of paying dividends and a history of increasing payouts over time. This ETF seeks to provide investors with steady income while also offering exposure to the growth potential of the U.S. stock market. In terms of performance, SCHD has outperformed the S&P 500 index over the past 5 years, delivering strong returns to investors who have held onto the ETF for the long term. Some of the top holdings of SCHD are Johnson & Johnson, Procter & Gamble, Microsoft, JP Chase & Co., and Verizon Communications. These holdings were reported to make up approximately 8% to 10% of the total portfolio. The exact holdings and weights can change over time and may vary depending on the source of information. The dividend payout for the Schwab US Dividend Equity ETF, SCHD, is currently yielding around 3.35% per annum based on its last dividend. SCHD paid $2.56 per share in the past year in dividends to its investors. It's important to note that the dividend payout can fluctuate and past performance is not indicative of future results. It's also important to consider other factors such as the overall economic conditions and the financial health of the underlying holdings when making investment decisions. On the other hand, we have the JEPI ETF, also known as the JP Equity Premium Income ETF. This ETF invests in a diversified mix of stocks and option strategies to generate income. It has a slightly higher expense ratio of 0.42%. It is an actively managed mutual fund that invests in high-quality, dividend holdings. The fund manager of JEPI uses a bottom-up approach to select stocks that have a solid dividend track record and have the potential to grow their dividends over time. In terms of performance, JEPI has a strong track record of outperforming its benchmark index, the Russell 1000 Value Index. The fund has delivered strong returns to investors, but it comes with higher fees compared to SCHD, which is a passively managed ETF. Some of the top holdings in JEPI include Nestlé SA, Novartis AG, Roche Holding AG, Unilever NV, and Sanofi SA. JEPI has a dividend yield of 11.56% and paid $6.36 per share in the past year. The dividend is paid every month. To summarize, both SCHD and JEPI are solid options for investors who are looking for dividend income. However, if you are looking for lower fees and passive management, SCHD may be the better choice. On the other hand, if you are willing to pay higher fees for the potential of higher returns and actively managed investments, JEPI may be the way to go. That's it for today's Money Masters, where we help you make informed investment decisions. Thank you for watching, and don't forget to hit the subscribe button for more helpful content. Until next time, happy investing.